So, if you're out there thinking that you might want to buy a new house or a new property, and you're kind of curious about what's going on with credit scores due to higher interest rates, today we are going to bust 5 credit myths that are running around right now. So, hey Rhonda, how are you?
Hey, Melissa, doing excellent.
So, this week I got a call from a client who is a renter, and he said, "Oh my gosh, did you see this great ad out there? Tell me if it's true or not. If I pay this credit company to add my rent payments and have my landlord, I guess, take over and tell them that I have been paying my rent on time, does that raise my credit score in order to get a mortgage? Should we be advising our rental clients to go out there and participate in this program? Or is that just one of those things where somebody's figured out a way to make money off people who are trying to accomplish a goal?"
Well, I'm going to answer that with both a yes and a no. So, if you are applying for a consumer loan, like a car loan or a credit card, then your rent payment history can affect your credit score. The thing is, though, with a mortgage loan, we use a totally different set of credit scoring criteria, and it's actually very antiquated, honestly, and it does not actually pick up on those self-reported rent payments. It would be good to show a good positive rent history, and we're going to see that with our eyes, but it's not going to actually affect your mortgage credit score. So, depending on the type of financing that you're looking at achieving, you could see a benefit by adding those rent payments onto your credit report, and they're called self-reported. You can do the same thing with your utilities, and it could improve your consumer credit score, but it will not have an effect on your mortgage credit score. But we will see it, and we'll see that it's a good positive payment history, so it's not necessarily a bad thing, but it won't improve your mortgage credit score.
Okay, so if you're thinking about buying a property, think about perhaps saving that money and putting it towards your down payment or your closing cost instead of adding your rent to your credit report, because it sounds like to me it's not really going to impact. And with rising interest rates and low inventory, it's important for all first-time home buyers and people that are renting that want to become buyers to have as much money stashed away when it comes time to buy a home.
Right, and we can verify your rent other ways with verifications of rents that we can send to the landlord to fill out and verify that your rents are paid on time. So we have other means to get the information. So putting it on your credit report doesn't hurt, but it won't help your mortgage credit score.
Okay, so myth 1 debunked. Now, myth 2. I've had several buyers say when I'm out shopping with them, should I get pre-qualified with more than one lender? I don't remember the rules. I know that when TRID came out, part of TRID was to encourage consumers to shop mortgage lenders, but I think there's some rules there. So if I'm shopping with a buyer in 30 days, they decide, maybe I should go shop lenders. Is that a good thing or a bad thing?
Right, so the piece that comes into play here is the inquiries into your credit report. And remember that inquiries have a 10% impact on your credit score. So if you have too many inquiries into your credit report, then eventually it can drop your score. So I hear things all the time too about 14 days, 15 days, 30 days, what's the real answer? And the real answer is that two of the credit bureaus, and this is why there's so much confusion, two of the credit bureaus say you can have a 15-day window to do that shopping, and the inquiries won't hit your score. But one of the bureaus says, no, you only have 14 days. And that's why this confusion comes into play. So I just tell everybody 14 days to play it safe. And so, yes, it is not a bad thing to do a little bit of comparison shopping. But if you are going to do that, you want to be very much on target and get that all done within at least a maximum of 14 days.
Okay, so again, good idea to be shopping lenders. Just do it within that very narrow window of time. Make your first inquiry, make your first application with a mortgage lender, and do the others within no more than 14 days so that you're not ending up having an issue are dinging your credit a little bit, because right now the better credit score you have helps with the higher interest rates. So you want to try to combat the higher interest rates with a better credit score, correct?
Yes, exactly, exactly.
Okay, so now I've made application. I get this credit report from my lender. There's collections on it. So I read, and I have several clients that have said, oh my gosh, you should race off and pay all those collections because it'll boost your score. True or false?
Yeah, so there's a couple of different pieces to the collection accounts. One is how current is that collection account, and the other one is the type of collection account. So with most of our mortgage loans now, if you have a medical collection account, then we're going to kind of put it in a little different category and not hold it against you. If you have a collection account for a credit card or a utility bill or some bill that you didn't pay, then those ones are a little bit different story. If you borrow the money, you sign a little promise to pay back, so you should pay it back and fulfill your promise, right? But when you have medical collection accounts, then usually it means something happened in your life. And oh my gosh, these doctor bills are so crazy, and sometimes you get bills from doctors you didn't even know existed, but they looked at some report and then you got a bill. And so the medical collection accounts kind of go in a little bit of a forgiveness category. But if that collection account is more than 2 years old and you go pay it off, now it brings it current, like a paid derogatory account instead of a 2-year-old unpaid derogatory account. And so when you bring it current, because anything that happens in the most recent 12 months and then 12 to 24 months will have an effect on your score. Once it's more than 24 months old, then it starts fading out of the scoring history. So if a requirement of your loan is that you must pay off collection accounts, my recommendation is that they're not paid off until you go to closing and we pay them off at closing. Because if we refresh that credit report during the process, you will see a decline in your score before you see it improve with a paid off collection account. So please get really serious professional advice on paying off collection accounts if you're buying a home before you run out and pay them off. Because if it's brand new, it just happened last month, go ahead and pay it off, get rid of it. But if it's an older one that you just didn't even know existed until this credit report was pulled, wait until you get advice from your loan officer on whether to pay it off now, or if it has to be paid off at all, or if it does, can it be paid at closing.
And so if you've been watching our shows for a bit, you know that Rhonda and I really do talk about the power of working with local people in your search for your new home or when you're selling a home. And this is one of those main reasons, because we do have the big box lenders that do a mass amount of marketing. The problem with those guys is they're not having those conversations with you as a buyer. They're not sharing that information with you always. And then what happens is you think you're doing the right thing, then all of a sudden you get a decline from the mortgage company now because they're pulled your credit again. And right, because you pull credit right before a property records, right? You pull a borrower's credit again, what, how many days before a property records?
Within 10 days, right? And so I just had this situation come up as an example, and my borrower had a fairly low credit score. It was around 620, and their internet lender recommended that they pay off a medical collection account. Well, that collection account was like 5-6 years old, and so when they did pay it off, it dropped their score to right around 600. And that lender had a minimum 620 credit score or you were out. So they came to me, and I could go down to 580 for this FHA loan, and so we were able to make it work for them. But that was kind of the bad advice that they got, was to pay off that very old medical collection account, and then it brought it current, and it dropped their score below that lender's minimum credit standards. So yeah, please just get some really good advice.
And what could have taken place, because we've done this before with several of the borrowers that we've worked together, is you've just had those statements and those balances added to the closing costs at the end of the loan. And when we go to closing, the borrower actually brings in a cashier's check, not only for whatever their portion of the down payment, but the closing costs, but they pay those items off, which then gives them an opportunity after closing for it to affect their credit score, and then they can let it ride for a little while to restore, and it's not affecting them or impacting them. And in today's rising interest rates, it's really super important to keep your credit score as high as you can possibly keep it.
Absolutely. And some of the programs, say, for example, FHA, they allow you up to $2,000 worth of unpaid collection accounts before they require any of them be paid off. So depending on the loan product, even though there is something outstanding and open, you may not have to pay it off. And again, medical doesn't count into that number because they kind of get set aside in a little forgiveness category. So it's really important to get some good advice.
So I got my credit report. I'm looking at it, and there's some things on there that I don't think are right. So I'm going to race out and dispute them. Is that a good thing or a bad thing?
Well, so again, depending on the loan product, the dispute kind of temporarily removes that account from the credit scoring models. And so it temporarily sets aside that negative information, and your score is affected. But again, depending on the loan product that we do, say for example FHA again, they require that we remove any disputes to get a real credit score, because those disputed accounts do impact your score, but it can't just sit there forever. You know, if you're going to dispute it, you need to follow up with it, and you need to get it resolved within a short period of time. And then once that time frame is up, and it's either resolved or not, you need to remove that dispute to get an accurate credit score. So just disputing the accounts, yes, it does impact your score, but we also know that it's impacting the score, so we're going to make you remove those disputes and get a real score. So you could get pre-qualified with a different score with the disputes still there than what your score may be with the disputes removed. And that could affect your qualifying.
Well, and exactly, because you just told the example of the borrower who listened and paid off a collection and lowered their score, and then they couldn't qualify for that loan product with that particular lender. So again, I can see how the disputed one would do the same, especially if I'm a first-time home buyer and I want to take advantage of the FHA home loan program. I can't do that if I have disputed credit inquiries on my report, because I have to clear those. So again, if you're out there thinking about making a purchase, one of the best things to do is get in front of a local lender who you can meet face to face, who will actually cover all of that information. If you're currently working with a lender and you're going, oh my gosh, I've never heard of these things, and you're buying a home in Alaska, we can give Rhonda a call and you can get set up and learn about how to take care of yourself. Now, let's go to the fifth one. Late on my car payment. What happens to me? Did I just tank my credit?
So let me ask you this. Let's say like the payment was due on the 1st. What day did you make your payment on? Okay. And so you probably had to pay a late fee, right? Because they might have given you a 10 or 15-day grace period before a late fee is assessed. But you didn't make it more than 30 days late. So yes, you paid a late fee, but what we're going to see on the credit report is that you were paid on time. So our definition of being on time is that you made the payment within the 30 days that it was due. So if you made it on the 31st day, then it's going to impact your score. And so even if you have to pay a late fee, never let that payment go more than 30 days late. And one of the things that you can do is like on my credit cards, I only get paid once a month. And so I have everything set up on an auto pay to no matter what, just make the minimum payment due. And then when I get my paycheck, I'll go ahead and pay what I want to on it. But no matter what, everything is set up on auto pay to pay at least the minimum payment due, so that I'm never ever in that situation. If you make a 30-day late payment on something, say like your car loan, Melissa, oh my goodness, you can see 50, 80, even 100-point difference on your credit score for that one late payment. And the sad thing is that if you had a really great credit score, let's say like you had a 800 credit score, and you've never had a late payment in your life, and you make one late payment, you're actually going to get hit harder with more points than a client that has a few little hits here and there, because that's kind of their norm. But when you have never made a late payment in your life, and then suddenly there's one, the credit scoring algorithms kind of freak out and they say, oh my gosh, what's happening with this client? They've never done this before. Let's tank this score until we figure out if there's a pattern going to happen, or if this is just a innocent mistake that something got missed this one time. And so you will see that huge hit on your credit score. Now the good thing is, if it was an honest mistake, a couple of things you can do is to call up your creditor and say, look, I've never ever made a late payment before. This is what happened. I was sick and in the hospital, or I was on vacation, or something happened. And see if they'll give you a courtesy removal of that late payment. If they won't, then you're kind of stuck with it, and history is just there. The good news is that every single month that goes by after that late payment is going to have less and less and less impact on the score. So time will heal it, but it's so critical to never let that happen to begin with. But just remember that as long as it's made within the 30-day window of the due date, then it won't get reported as a late payment on your credit report.
So we just covered 5 credit myths, and we debunked 5 different myths that have been running around. These are actually from real live questions that borrowers and clients of mine have been asking over the last couple weeks. And so Rhonda and I just thought it might be good to share that with everyone, to let everyone know the real truth behind some of these myths. Remember, if you're renting and you want to increase your credit score, great, you can add your rent to your credit. However, it's not going to impact your mortgage. If you have a collection account, don't pay it off until you and your lender have had a very serious conversation about it. Don't dispute a credit issue unless you have a serious conversation with your lender. Make sure you don't. Oh, what about if I have a revolving credit line? So let's say I went to Saddlers and I took advantage of the PFD sale, and I went to Saddlers and I opened up a revolving credit account, and I bought the furniture I needed for my house, and I know I'm not going to need any more furniture. So I just want to close the account, but there's still a balance on the account. What does that do to my credit? If I close the account, shouldn't that have no more impact on my credit score?
Yeah, that's kind of a comment that's been going around lately, that, we know that 30% of your score is based on your balance compared to your limit on your revolving credit cards. So the higher the balance compared to that limit, then the lower your score is going to be. And so unfortunately, when you go to something like Saddlers and buy some furniture, and you buy a $3,000 living room set or something, and they give you financing for it, it looks like a credit card to the credit bureaus because it's revolving, because they want you to come back and buy more furniture once you pay that one off. So you buy $3,000 worth of furniture, they give you a $3,000 credit limit, and guess what? It looks like you're maxed out on a credit card. So the thought was, we'll just close that account, and then it won't count as being a maxed out account because it's closed. But that's not true. As long as there's a balance on that closed account, it's still going to act to your credit score just like it were open. So closing it is not going to fix that challenge.
So again, another one debunked, which that makes actually number 6. So the last one was, don't make a payment later than 30 days on car payments or credit cards, because you heard what Rhonda said. If you have an 800 credit score, you're going to get nicked badly. If you have a lower credit score, you're still going to get nicked. So just put all of your accounts on auto pay. And it doesn't have to be for the full amount. Just pay your credit cards, the minimum amount, put it on revolving. Rhonda and I do the same thing because I'll go in to pay my credit card when I get a commission check and it'll say, oh, do you want to cancel your auto pay? You're showing that you're going to be making your minimum payment on this date. I'm like, no, just let me make an extra payment. So, yes. So anything else, Rhonda, that has to do with credit myths? Anything else that our viewers could learn today from kind of the weird things going on out there? Maybe AI is spurring all this on. I don't know. There's a lot of false information out there on the web. So,
yeah, before you pay for any kind of a credit improvement, please reach out to me or your lender. I mean, before you enroll in anything like that, let's have that conversation. I do have a credit simulator, so I can say, well, what happens if we do this or that? What does your score go to, and how long will it take to get to the target score that we want to reach? And remember that just because your score might be a little bit lower does not mean that you can't be a homeowner. It just means that we might have to do a certain specific program, or maybe we can do a couple little fixes that will take 30 days. Maybe some things will take a little bit longer. But just get some really good solid advice that doesn't cost you any money, because it seems to me like the ones that you have to pay money for might not always be the best advice. It might be a little bit misleading. So look for somebody that knows what they're talking about and just get that free advice. You don't need to pay for it.
well, and especially if your end goal is to achieve home ownership, then start first with the local mortgage loan officer, because they're the ones that are really going to tell you truly what they see every day and what the underwriters flag and what the trends are. So again, this new trends that are out there about rent being added, it's kind of debunked. Yes, it'll help you with consumer credit, but it's really not going to help you get a mortgage, because always when we send clients over to Rhonda to get pre-qualified that are renting, then she has them fill out a form and their landlord has to verify rent, that it's been paid on time. So again, lenders already have that all squared away and they don't charge a dime for it. So like Rhonda said, save that money. Don't pay an outside company until you've talked to your local mortgage loan officer. So how do you get hold of Rhonda? At the end of this video is a screen that has all of her contact information. She will answer the phone. You can call her, text her, email her, or you can go to her website and click a little button and schedule a calendar meeting with her. She'll talk to you over the phone, or she'll do a Zoom call with you just like this one, so that you guys can talk face to face and you have all your questions laid out and she'll be happy to answer them. My information is also on an end screen, so feel free to reach out to me. We both live, work, and do business right here in Alaska and love helping our clients navigate this whole mystery of home buying and home selling. So we'll see you next week, Rhonda.
All right, see you next week.